Hello everyone, it's me, the Boss Hog. This week was pretty challenging for sure, and this title seemed appropriate because not only did I get hammered, I got Warhammered in reference to a trading update from Games Workshop. But it wasn't just them, it was across the board. But let's see what's actually happening in detail. Alright, so first of all, in terms of the actual profit and loss by day, I mean, it was pretty bad. Monday was a bank holiday in the UK for the Queen's funeral, but the rest of the week was pretty bad. Notably, on Tuesday was very much impacted by Games Workshop. Outside of that, though, I think it was just broadly speaking market sentiment, macroeconomic news, everything from sort of inflation figures. The UK's budget had its own ramifications that were broadly negative, although it did benefit a little bit from foreign exchange rates, but I think overall it broadly evened out, as well as sort of inflation figures and that sort of stuff as well. So I think many people would have had a difficult week, but actually I think the fact that I had some of my larger positions seeing double-digit falls probably meant that I did worse than many people, so it wasn't great. I did decide to add £800 in this week. This wasn't actually expected. I didn't really expect to put any more money in before the end of September. But basically, I did a bit of side hustling in early September, just doing a couple of industry consultations. So that money coming in, combined with the fact that we had like a relatively healthy current account, meant that I felt comfortable putting in 800. So that leaves us continuing to run 1 week behind of our plan, which is to maximize and top out both of our ISAs, so mine and my wife's, by the end of March. So that's progressing at least. Two dividends this week, including Games Workshop, which came in very late Friday the week before, but I didn't have a chance to spend it, so decided to keep this all together. This is my second large dividend of the month. I do technically still have another 5 dividends to go, but 3 of them are on the 29th. I think, sorry, 2 of them are on the 29th, 2 of them are on the 30th, and 1 of them is on the 26th. So it's quite plausible that the 2, that especially on the 30th, I won't get before market closes. Obviously, if not, then they'll just fall into the next month, but it should still be my second highest month on record regardless. And this week, again, I'm just going through my graphs, basically just sharing them. This is my current allocation by sector. I don't always directly take their listing from my broker. I do have a slight difference in the breakdown, although oftentimes it's very similar. Just, I have slightly different things on for things like mining or some of my utilities, etc. I would note that it's a pretty wonky graph at the moment. I don't have any healthcare at all. I definitely want to find an ETF healthcare. Just something nice and solid with all the big farmers would be lovely. So it's pretty wonky and very heavy on technology. It's also interesting for me though that since I've been buying ETFs because of my wife's job, she works in private equity, so we have quite a restricted what we're allowed to buy. So the ETF here, that's the first time that's ever been above 5%. So I do expect that to continue to grow over time just because of that. And also now that this is, our investments are starting to account for more and more of our wealth. It's currently about a third overall. I do expect to spread the risk and to buy some more ETFs anyway. So that's that. And yeah, so I guess overall this week it was pretty rough. I think everyone suffered, which always helps because misery loves company. And even within that, there were some caveats, some ways that I felt better than losing, over 4% or about 4% of your portfolio value in a week would lead you to believe. So I can talk about that more now. We're going to talk about some of the earnings, etc. as well. So let's break those down. Before we do go on to the breakdown though, actually we haven't done this for a few weeks just because I haven't been buying too much, but I do just want to go through this very quickly. So my dividend income for Games Workshop and the real estate ETF, I just reinvested, more than happy. A slight average down on the REIT ETF, as fairly significant average down on Games Workshop. Actually, I was a bit disappointed I didn't get 2 shares, just 1.99, but fine. I decided this week in terms of my 800 additional to focus on SMT, so 500 of that 800 went into that. That's really for 2 reasons. So first of all, I did some research into SMT last week and really liked what I was seeing, and also I've done a little bit more reading up. Again, we'll go into detail, but the combination of my research basically makes me feel very comfortable investing more heavily in SMT. I actually want to grow it a lot. So originally my plan was just to average this down to £10 and then write it out, but I've decided to actively continue to buy. It's currently about £8, so I'm still on a pretty significant loss here, sort of over 10%. But again, I'm going to continue to average down at these kind of levels. The fund has a very good historic performance, and it recommends that you hold it for 5 years, where it has performed really strongly on sort of 3, 5, and 10-year measures. Obviously, to counter that, it has been a very rosy period for the kind of companies that SMT buys over those timeframes. But again, I like the direction of travel here, and I'm very confident buying it for the long haul. And then just in terms of the other £100 that I spent on the ETFs, basically I put £800 into my personal ISA, so instead of my wife's, and these were 3 of the 4 other ETFs I had, so I just basically sprinkled between them. I do also have WCOS, which is like a consumer staple ETF, but it's still green at the moment. And in this market, the average PE of its holdings was still above 20, which to me seems quite expensive. There are some really good holdings in WCOS. My favorite's probably Costco in their top 10, but I didn't really feel good averaging up in the current market. And to be honest with you, I'm quite happy increasing my holdings in the other ones as well. So just my rationale there. All right, so standard stuff here. I put this in order of my pluses and minuses for the week. Obviously, more reds than greens, but some greens. And then anything highlighted, I just want to talk about. So first of all, right at the very bottom is Games Workshop. They had a trading update rather than a full release. Their trading update was broadly okay, I suppose. Revenue's up modestly. Interestingly, their licensing revenue is down slightly, but this half is always very small as a proportion of their overall licensing fee, so I didn't really read too much into it. And to be honest with you, I'm quite optimistic about their pipeline of licensed stuff that's being developed at the moment. I think the main concern was that margins continue to reduce. I'm not hugely surprised by this. Their logistics have only just got up and running. The kind of hydrocarbons that go into their molding machines is obviously very expensive at the moment, as is things like shipping. And they'll also be suffering from a weak pound as they try to export, but then of course they'll be potentially benefiting because it will be cheaper for other people to buy. So we'll wait and see how that plays out. This is still primarily a UK business, but it has been expanding internationally for the last couple of years. So I wasn't as disappointed with the market with these results as the market was. I mean, at one stage, like the share price just crashed like 15% in a day, did rebound slightly. But I continue to think that sort of at about 15 PE, this is the kind of quality company that you want to be buying. Yes, margins have been reducing a little bit, but they're still like way above any of the big tech. I mean, they're still really good. And again, I remain quite optimistic on this for the future. So I was more than happy to reinvest my dividend here and pick up a couple of extra shares. I'd also point out as well that Games Workshop at the moment is now quite a heavy dividend payer. And I think that kind of does reflect the disconnect almost between cash flow and share price. It's not actively a dividend stock, it's still a growth stock, but dividend at the moment is above 4%, which seems odd. So yeah, for me, I still have like a target around the £100, and I'm still confident therefore buying, even if it looks a bit weird me saying that when the share price is at the 60s. So that was my thought on that trading update. I did do more of a deep dive last week into Redrow. But just to say that most of the fall here was around the going ex dividend. There was, we'll see how it shakes out with house builders in the latest UK budget, because actually I would expect them to be one of the winners overall. So even though they had good results a couple of weeks ago, and even though I would say it's broadly favourable for them in terms of macroeconomic changes and political changes, the fact that they had a very chunky dividend and it's just gone ex-divvy was responsible for about 3/4 of the fall here. This was quite exciting for me as somebody who remains very bullish on Hollywood Bowl. It was my best performer this week in terms of pounds, actuals. Really, the reason for this is it rose in sympathy with results from 10 Entertainment, TEG. This is a competitor who I view as a weaker business than Hollywood Bowl. Interestingly, both Bowl, though, and 10 made the argument that summer is typically a fairly poor time for a bowling alley. People go on holiday, they don't want to be stuck inside, etc., etc. And 10 are actually quite surprised at how strongly they performed over summer. My, and indeed their opinion is that because people couldn't get away, flights were all over the place. Maybe it was even like too hot and you wanted to be inside, right, rather than outside. It was so hot that who wants to be, 40 degrees heat when you can go into an air-conditioned bowling alley? So it may well have played a result of that, but that sort of led people, including me, to believe that Bowl is actually going to also have pretty good results. So this will be interesting to see when their results come in, which is fairly soon now, just a couple of weeks. And we will definitely be having a look at that because it is still quite a large holding for me, sort of 3.5% of my portfolio. And yeah, personally, I believe that bowling offers good value family fun. So even in a kind of high cost environment where people don't have as much money, I still think that bowling is going to perform reasonably well, and I think Hollywood Bowl is basically the best in the sector. So I'm optimistic for this, and the market kind of rewarded it just because its competitor had very strong results, in fairness. Kingfisher, I did think about doing a deep dive this week, but I'll try and do that in the near future, although I've still got so many other things to do, but we'll get around to Kingfisher eventually. Its results, if you like look at it on a very cursory level, the results slumping 30% is of course dreadful. However, it was basically like against the DIY boom during COVID. It was at pains to point out that, you know, as well as those tough comparables, it's now quite far ahead of its pre-COVID levels, and basically continues to sort of see good signs of trading in early H2. So again, we'll see how that shakes out. I still think that in terms of value and to a certain point turnaround, Kingfisher represents a reasonable entry at current prices. Even if you accept the fact that some people might be putting off DIY projects, maybe again not enough money, what Kingfisher are actually seeing is the big ticket items are still holding up reasonably well, and they're expecting sort of like for like sales to only be down fractionally in the second half of the year. So again, assuming that shakes out, I think this is a really cheap stock that offers upside if you believe in the general direction of their turnaround. So I still feel fine owning Kingfisher, by the way. So it's only a little bit red for me at the moment because I'm a relatively new investor, but I think the results are okay, and that I wasn't hugely surprised with them. And to be fair, I would say neither was the market. It was broadly in line with your expectations, and the guidance was more or less unchanged in terms of the rest of the year, so fine for me. And I did just want to talk in a little bit more detail about Elixir. I mentioned them last week that the results were coming, and I did actually look into those results, so let's do that now. All right, so in terms of Elixir International, first of all, this is absolutely penny stock territory, about £350 million market cap. They term themselves a challenger consultancy, which I kind of like. They're basically a management consultancy. So again, think of like Boston or, you know, those kind of companies that sort of deliver results and recommendations to other companies. You know, you like of McKinsey as well, I would include in those kind of companies. This is a very small outfit though. It's basically getting itself up and running, but it's already quite profitable, and I think it's got a really strong foundation. And like reviewing the results didn't change my mind, and if anything really convinced me that they're making some great acquisitions, that they're able to like cross-sell very effectively and kind of upscale and basically over deliver on the results that they were expecting. And also like some of their buys, especially their big one that we'll get to in a second, you know, they got that on under a 10 multiple, which for me is just really great. I think they picked up basically a deal on that. So just a bit of background there for Elixir. In terms of revenue growth, it was plus 39% year on year, obviously very strong. They did break that out between organic at plus 8%, which is kind of okay. I would want to see that a little bit stronger, but because the acquisitions delivered so well, actually I was quite happy overall. But I would say that if anything, I was slightly disappointed with organic growth. I'm very happy with the revenue growth from acquisitions. The midpoint here of guidance is 72.5. The range is 70 to 75, but for me, I just prefer to use a single number, so I just picked the midpoint. Assuming they hit that, that would be plus 43% year on year. So that would be very strong if they were able to come in at that. They highlighted that, again, especially because of their acquisition, US revenue is now 40% of total. Their reporting streams are divided into three, basically US, UK, and rest of world. UK is still slightly dominant, but not by much. It's pretty close. And then the rest of the world is sort of EU and Australia primarily. So that's just to give you, again, a bit of a breakdown in how that looks. They nudged up their earnings for the year, but honestly, I don't know why they bothered changing it. They put it up from 19.9 million to 20 million, so I really mean nudged. Doesn't really get much smaller than that, so basically unchanged in the scheme of things. And the EPS for the year, basically 30p. That would give them a 22 PE, which again, I think is actually okay. I think I'm pretty happy with such a kind of high growing, capable company that, again, I believe has laid a really strong foundation. I don't think that's expensive. I get that the market's very beaten up at the moment, but I'm quite excited to have a professional services company in my portfolio, a high growth penny stock. I don't have a huge position in this, by the way, less than 0.5%, but I'm really hopeful for it to be like a big multi-bagger in the future, you know, like 10x plus. I think it's kind of one of those that's got a lot of potential to run or potentially be snapped up by somebody else. But for me, this is all about a reasonably risky, but not that risky because it's already profitable, small position that I hope to it will continue to grow, and doesn't look to me too expensive at the moment. In terms of their strategy, I would say that their 4-pillar strategy, although they rave about it, is quite basic. So increasing revenue per client-facing partner, that's their measure. They highlight plus 23% year on year, so great. Promoting partners from within and hiring partners from external. Again, this is like normal HR stuff. I don't think there's anything too extraordinary. I would highlight that their partners are serious partners. You know, they've been at things like KPMG, those kind of other established Big Four and general consultancies. So like they do, it's not like, you know, a barista here. No offense. These are people who are like already seasoned professionals that they're basically poaching from their more established competitors. And then the 4th pillar is acquiring new businesses. So IOLAP was the big one that's basically transformative. But they've bought a couple of others as well in the past, and apparently at the moment they have 22 candidates, including 4 that they've got offers outstanding for. So I assume they're not as big as some of their IOLAP, but I'm assuming that again they're going to just actively look to grow through acquisitions. So I expect this company to continue these strategies. And to be fair, if they continue to perform and over deliver and pick up companies at good multiples, I'm all for it. Also, they seem to like number 4. There's a deck in their earnings where they talk through this, and you know you've got like 3 different areas divided into 4. So you've got the 4 pillars, and then they're looking to invest into 4 areas, which is cost reduction and sourcing. That's one area. Strategy, innovation, and digital. So again, I don't think it's too exotic or unusual, so I don't want to waste too much time on it. Their investment focuses for the year, again divided into 4. You've got data, risk and compliance, ESG, and M&A. So again, I kind of get it. They did actually pick one of their smaller acquisitions, and indeed somebody they poached a partner from was from a dedicated ESG provider. I personally have some dubiousness about ESG. Sometimes to me it seems a bit of a box ticking exercise. It's something I personally don't actively look into. But at the same time, if you know, especially on the governance side, I think is important. Then fine. But I do understand that, you know, some funds will only touch you, or some business opportunities are there, and you have to sort of burnish your ESG credentials. So this should help with that. And likewise on the M&A side as well, that can be quite transformative, right? Lucrative deals, etc. So it makes sense. And in terms of their future focuses, again, all of these to me made sense. Which is like, it's kind of a fairly basic video business to understand. So a basic overview on this video. This is a company that comes in, basically tells your company what they should do better, and provides advice. That's kind of it. It's not really redefining anything. The challenger aspect is the fact that they're small, and you know they're basically building from the ground up. Future focuses here, therefore, being cyber. Purpose is a bit willy-washy, but it's like business purpose. You know, your reason for being, fine, mission statements, that kind of stuff. Supply chain makes sense. Operational resiliency, I actually think, is really important. That would include things like cyber, right? How does my application recovered if I'm hacked, or if it goes down, or etc., right? So that makes sense to me. Process here, that they talk about Lean Six Sigma, but really what they're talking about is processes, right? How do we make things run more efficiently? Automation, that kind of stuff, and new technology that would be of interest to that company. So all of this stuff kind of makes sense to me. It's simple. Now, in terms of analyst estimates, they're quite wide-ranging. I would point out that of the analyst estimates, and because it's a small stock, it's not hugely covered, to be fair. So, you know, it's less. I think it's 5 different analysts provided numbers for this. So it's currently actually outside of that range on the downside, but not by much. But yeah, really a very not well-covered stock with considerable top and bottom levels. They're not too closely aligned at all. In terms of me, like I say, it's a volatile holding. It's also got a very big spread, and it doesn't really have a ton of liquidity in terms of the stock, a liquid stock. So it's not so easy to buy and sell. It's it's a small stock without much free flow, and so the spread can be quite wild. So although it's a small position, realistically here though, I think you can justify a fairly easy calculation of sort of 30p EPS times 30 for the PE. I think that's a defensible position. Maybe you could go more to 25. So for me, I'm sort of in the sort of high 7s to 900p kind of range. So again, sort of, I suppose more toward the upper end of analyst estimates, but not by much. I think these analyst estimates are reasonable. And again, I think you're basically picking up a small growing company that's, it's going to take you a while before you see, you might never see anything like dividends, but this is a company basically still in its formative stages that has a lot of room to run. So we'll see how it goes out, but it's effectively a professional services consultancy company. Obviously that's what it does. So it's simple to understand in a way. And really here what you're betting on is kind of the people and well, I think actually mostly the people, which maybe does explain the sort of the 4 pillars. I've been ridiculing it a little bit because it sounds quite basic, but actually in this kind of businesses, it is all about the people. In fairness to Elixir as well, like they talk about sort of employee ownership programs, that kind of stuff, like highlighting longevity as well, even though it's a new business, how long those people have been there, promoting from within. So they're going out, and looking for those kind of people who want to kind of, work 80-hour weeks and go through at least 2 divorces. And from that perspective, you can definitely build a business from that. So if you're confident in how they're building and how they're acquiring and the organic growth possibilities, then to me this does look like a good opportunity, honestly. So that's my takeaway from Elixir. I know a couple of my viewers are also similarly bullish on it. If anyone is bearish, I'd be interested in viewpoints. Maybe it's sort of a low barrier to entry, and or you're running into the big boys sooner or later. Those would be my immediate concerns, but honestly, I don't really have too many. It's already profitable and it should be growing from here. So anyway, I do have a few more minutes, hopefully, to talk about another fund before we finish the video. All right, so I just wanted to do a follow-up of Scottish Mortgage Investment Trust. So we spoke about these last week, and I was kind of surprised during my research that it has such a heavy exposure to private companies. For me, and UK investors on the whole, we don't have the ability like you do with the American IRAs to basically put privately held companies into an ISA on the whole. It's way more restrictive. So for me, it's super attractive that there's this fund here that basically allows me to have exposure to private companies. So about 30% of the fund, 28%, is held within private companies. And what I was speculating last week is maybe the reason that there's a disconnect between the net asset value and the share price is specifically because of the fact that outside investors were worried about how private companies had been revalued. And I suggested at the time that 30%, in order to get this net asset value difference, you'd basically have to assume that their private companies had reduced by 30%, which seemed a bit high. However, since that point, I was talking about it in a Discord group, and somebody sent me a link, which I'll share basically in the description, where Bailey Gifford go into quite a lot of detail about exactly how they do price their private companies. And to be honest with you, it made me feel really good. And it did also make me think that it doesn't really explain the net asset value difference. What happens is every 3 months, as a minimum, each one of their private investments is reevaluated. And reevaluations are done by a dedicated team, so they're completely separate from the fund managers, and they're also overseen by an independent third party. Also, as well as that, not only are they done every 3 months, but there are like a bunch of different reasons why you would have an additional reprice. So everything from sort of like, there's an upcoming IPO, new technology, a competitor has had an IPO, a publicly traded company changes value, right? All those kind of things are going to basically trigger an additional reevaluation. So Bailey Gifford, but their fund SMT, pointed out that 96% of their portfolio has been revalued at least twice, and 44% at least 5 times over the last 8 months. So that made me feel pretty good. And the table on the left here is already been shared, but this is their top 20 holdings. But I thought the graph on the right, is new. And for me, this was kind of interesting. So what it does show is that as an average, their private companies have been written down 22, 23% during this year. But actually some of them have actually been written up, right? So there's 2 different purple bars there. One of them if you exclude the ones that have been written up, and one of them if you net it off. But either scenario, basically, they are still technically outperforming the Nasdaq as a comparison. And again, as I highlighted last week, a lot of people compare SMT to the Nasdaq. When you actually look into what's held within SMT, I don't think it's an entirely fair comparison. I think there are other funds that would actually be a better proxy to Nasdaq. But primarily it's at least meant to be a technology-inspired fund. Although even that I take issue with. Long story short, however, the net asset value isn't really the market assuming a difference between that and the share price because of the private companies haven't been written down. My assumption is that basically fundraising rounds, which would also require another reevaluation, just weren't happening as often and therefore created that difference. But obviously that's not the answer at all. And to me, therefore, it kind of represents an opportunity to buy when the share price is running basically the second lowest discount it ever has. So at the moment it's like minus 12% on against its net asset value. So for me, it just seems like an opportune time to pick up shares. That was really the reason why I decided to buy more SMT this week and use that £800 deposit, majority of which for SMT. And I guess I just wanted to share. So I think SMT is a very unusual fund, and I think a lot of the expectations and the things you might read in the UK about SMT are a bit broad and not especially accurate once you actually look into what's in the fund. So I felt like it was worth sharing. For me, it's been one of the more, the most interesting fund I've looked at so far, and I just felt like it was worthy of a follow-up, basically. So that's all I have to share in this video. Standard stuff, comments, questions, etc. below. Thank you very much for sticking with me, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.